Have you ever had a trade stopped outright before the market took off in your direction? You placed your stop loss exactly where you were supposed to, but instead of riding the trend, you watched in frustration as the market reversed without you. Sound familiar? Well, I hate to break it to you, but it's not just bad luck, it's a trap. In this video, I'm going to expose one of the biggest ways institutional traders manipulate the market to take your money. But more importantly, I'll show you how to avoid falling for it, and even use it to your advantage to start trading like the pros. Welcome to LutaMarkets. I help traders like you understand how the market really works, beyond the basic technical patterns and retail traps. If you're tired of getting stopped out and want to trade smarter, you're in the right place. In this video, I'm going to break down the biggest trap retail traders fall into, the liquidity grab. I'll show you exactly how institutions manipulate price, where they hunt for stop losses, and how you can position yourself to profit from these moves instead of falling victim to them. Let's talk about something that happens to nearly every new trader. You see a breakout, you jump in, but instead of running in your direction, price reverses and stops you out. A few moments later, it moves exactly where you expected, but you're not in the trade anymore. It's frustrating, right? But here's the thing, this isn't random. Big institutions and smart money traders know where retail traders are placing their stop losses, and they take advantage of it. Think of it like this. The market is fueled by liquidity. Institutions can't just place massive trades whenever they want. They need to find enough liquidity to execute those trades without causing wild price swings. So what do? They create liquidity by triggering stop losses. They push price just beyond a key level to sweep orders off the table. That's why you see these fake-outs happen so often. It's not a coincidence. It's a strategy used by the big players. Instead of chasing breakouts, you need to start thinking like an institutional trader. First, look for areas where stop losses are likely stacked. These are liquidity zones, places where a lot of traders have placed their stops just beyond support or resistance levels. Now, here's where the magic happens. Institutions don't just push price past these levels for fun. They do it to trigger stops, fill their orders, and then move price in their desired direction. So instead of jumping in right away, wait for that liquidity grab. Once price fakes out and moves back inside structure, that's your signal. Instead of buying a breakout or selling a breakdown, you enter after the trap has been sprung. This way, you're trading with the smart money, not against them. Now, I want to hear from you. Have you ever been stopped outright before price moved in your direction? Drop a comment below and share your experience. If this video helped you see the market differently, make sure to hit that subscribe button and turn on notifications. I drop in-depth trading strategies like this every week, so you won't want to miss out. And in my next video, I'll show you how to spot liquidity pools before they happen, so you can get ahead of these moves instead of reacting to them. See you in the next one.